Peace, guys. Welcome back to ZENSFXHUB, where macro markets is simplified. In this video, we're going to talk about the DXY, yields, and gold. Okay, I think this video is going to be very important because a lot of people online are panicking right now, watching the price of gold just drop, not really understanding exactly why it's dropping, and also not understanding the fact that gold pushing back has nothing to do with the overall trend of gold. Gold is going to see 6,000 an ounce. That's going to happen this year, but right now there are things going on as far as with the war going on that is causing other factors that's impacting the price of gold. Okay, and we're going to talk about it. So the objectives of this slideshow, pretty much, right? I'm going to talk about what the DXY represents, why bond yields matter more than traders realize, how they both impact gold, and how to read them together instead of in isolation. Okay, so the DXY, if you know this already, you can kind of skip forward, but this is for the people who don't know, obviously. Okay, the DXY is the US dollar index. It measures the strength of the US dollar against a basket of major currencies. Okay, so when the DXY rises, that means the US dollar is strengthening. And when the DXY falls, that means the US dollar is weakening. Okay, gold is priced in dollars. So that's where their relationship begins. So gold versus the dollar, right? The basic relationship between the two. Most of the time, when the dollar is going up, gold is coming down. And when the dollar is going down, gold is going up. Okay? Why? A stronger dollar makes it more expensive globally to buy gold, so the demand for gold slows down. So pretty much, right? All I'm saying is when the dollar rises in value, globally it costs more money to buy gold because gold is priced in dollars. So it costs more money to buy gold. So investors are like, you know what? Like we don't want to pay that much money for gold right now, so we just gonna not buy so much of it. Okay? So before I continue, right? It's very important that when you are approaching the markets and you're looking at these charts, to think like an investor. Don't think like like a trader who wants to just get in and get out and make some money, right? If you're going to do this full time and you have a passion for this, whatever the case may be, try to put yourself in the shoes of a foreign investor so that you can understand how to approach the market from a different mindset. Okay, peace, guys. So look, I created a free Telegram where I break down every single trade that I take. I give you the fundamental reasons and I also give you the technical reasons. Whenever I make a new YouTube video, I post it in here so you can be up to date with it. And also, when I get in for a trade, I tell you the entry, the stop loss, and whether I put a TP, which most of the times I don't. And I let you know how much I'm risking on that trade. All right. So if you want to be a part of this community, you want to grow with me, and you want to make some money, join the free Telegram. Now, I will say that I am a position/swing trader, so I do not call out trades every single day. But the trades that I do call out, we get in and we hold and we ride the wave. All right. So join the free Telegram. The link is in description. I will see you guys in there. Peace. So what are yields? Bond yields is return investors get from, let me put this up, from holding government debt. Okay. So when yields rise, investors earn more from bonds. They get a higher percentage back in return. When yields fall, investors earn less from bonds and bonds become less attractive. Okay. Gold does not pay interest. So yields directly impact gold's appeal. Being that gold doesn't pay interest, when yields are going up, investors will rather put their money into yields for the time being so that they can actually make a return in investment, right? You got to remember, they're not playing with $10, $100, $1,000. These are people who are investing millions, if not billions of dollars, right? So if you are investing, let's say $1 million or $10 million, and you're getting back a return of 5%, of you buying that government bond, that government debt, that's a large amount of money that you can get in return. So imagine you have billions of dollars that you're investing. You feel what I'm trying to say? So this is why I was saying to think like an investor. There's something called real yields. And the way you get, that's like the real percentage, the real yield percentage. And the way you get that is you take the current percentage of interest rates and you subtract it from the percentage of the current percentage of inflation. And that would give you the real yield percentage, okay? So now gold versus yields. Most of the time when yields go up, gold comes down. When yields goes down, gold goes up. Why? If you can earn 5% back in bonds, holding gold becomes less attractive. If yields fall, gold becomes more competitive. Okay, so it's like, again, thinking like an investor. If I can't earn 5%, if that 5% that I was able to earn at one point now drops to, let's say, 2%, do I want to really invest my money into that right now, or would I rather put my money in gold, something that I know that is going to go up long term? Here's where things get interesting, right? When you put all these three things together: the dollar, yields, and gold. Scenario one, if the DXY is going up, if the dollar is going up and yields are going up, that's double pressure on gold. Scenario two, if the dollar is going down and yields are going down, that's very strong for gold. Now, scenario three, when you have mixed signals, right? When you have, let's say, the dollar going up but yields going down, or yields going up and the dollar's going down, gold might chop around, fake out, or become very volatile. This is where most traders get trapped. The current environment that we're in right now, we are in a risk-off environment, right? So that is bullish for the dollar. That's going to make the dollar increase in value. When oil spikes, that increases inflation fears. And when inflation fears increase, that makes yields rise. So we are in a scenario one environment, right? We have rising yields, a strong dollar, which is super bearish for gold. And this is why we've seen the price of gold drop today. And when I'm saying today, as of March 3rd, all right? But if panic intensifies, money floods out of bonds, yields fall, and gold can surge to the upside. You have to identify which force is dominant in order for you to know whether to buy gold or sell gold or whatever the case may be. All right? So what I want you to take away from this is never analyze gold alone. Always check the DXY, the 10-year yields, and the real yield direction, like what is the current percentage of yields and how much investors are going to get back. If gold is strong while the dollar and yields are both going up, then that's real gold strength, because remember, when yields and the dollar is going up, that's supposed to be double pressure, bearish pressure on gold. But if they're going up and gold is going up as well, then there's a serious problem and gold is really strong, and it's okay to hit that buy button. All right, so if you found any value in this video, once again, like and subscribe. Join the free Telegram where I share all my trades and I break down certain things. And I'll see you guys in the next video. Peace.